Let's bring in Katherine Lei, co-heads APAC Banks Research at JPMorgan. She's here with us in our studios. Good morning.
Good morning.
Yeah. So what do you make so far of what we've seen? Takeaways for you?
I think on China banks, so far, I think the profit growth of the large cap banks, like the SOE banks, have pretty much in line with expectation, the kind of like a low to mid-single digit type of growth rates. And also, I think the trend is pretty much stable comparing to like previous quarters' earning growth. But however, I think the disappointment is on what they call the joint stock banks. That is a term for mid-cap banks which have national footprints in terms of the business scale. Yep. So I think on those kind of joint stock banks, I think profit growth have been a bit disappointing so far. I think it's also because the large cap banks, they are more bold in terms of loan growth, if you look at the growth rates. But I think joint stock banks, they're taking a step back and taking a chance and then do a bit more de-risking, scaling back on the high-risk loans. I think that all resulted into the, I would say, sluggish profit growth of the joint stock banks so far.
How would you look at exposure to local government debt, for example? I mean, should we just assume that there should be more credit losses, given that Beijing has pushed for some of the big four to extend and roll over some of these maturities of some of these LGFV loans?
Sure. I think this is a very good question. So in general, banks just do not disclose like how much local government loans that they have on their book. Even if when they do disclose, the numbers looks a bit too low. Like say 2 to 3% of total loan book, that kind of numbers, right? I think it's because of it's a matter of classifications. Like they classify LGFV loans in a fashion that is maybe different from ours or different from like how market looks at it. So if you look at these portions of exposures that we estimated that total debt by the LGFV, including bank loans, bonds, and everything, by the end of last year was roughly about 56 trillion, all in RMB terms. Okay. I think by the end of now, like this year, or as at this moment that we are speaking, I think the number will be higher than the 56 trillions that we estimated earlier. The reason why is that if you look at a few sectors that the banks do lend to, is what we call the LGFV proxy sector, like utilities management, utilities production, transportation, and so on. And these sectors accounted for close to 50% of new bank loans in the first half of this year. And if you look at previous years, they only accounted for roughly something from like 20 to 30% of new bank loans. So I think local government do need money. I think this is showing like the financing needs from local government is rising. To your questions, on the asset quality front, no, we do not expect a surge in impairment ratios on the local government loans, mainly because I think the government is trying to provide funding to refinance some of the loans. So say, for example, if you just look at October in this month, October, we still have a few days to go, right? Yeah. But just in October, we saw close to 1 trillion RMB of new bond issuance in terms of the local government refinancing bonds. So they are helping a bit on that. And then you also see the central government is stepping up to issue some bonds and transfer to the local governments as well. So all this, I think, will ease the pressure on the asset quality side. Okay. But it does not mean that the banks do not need to share in terms of like the
national
responsibility.
Service. Yeah.
Well, so what does it mean for the banks? Right. I think the impact is mainly coming through on the net interest margin side. So that means that the banks will have to lower the lending rate when they extend loans to the local governments, right?
I was actually going to get to that. So what does demand look like? You know, what do revenues look like to you moving forward? You know, how is, because that's a function also of just the health of the economy.
Yeah. I think it's going to be a lot of pressure on the revenue side, because if you look at China banks, majority of their revenue is due from net interest income, right? Particularly the large banks. And then on net interest income, net interest margin have contracted like 20, 30 basis points depending on banks. And we expect that net interest margin to continue to contract sequentially in 4Q and also into next year. But of course, the magnitude of contraction may not be 20, 30 basis points that we have been seeing, but still the trend is going down. I think how much it's going to contract depending on one very important factor is that how much lending rate cuts the banks are going to do for the LGFV loans when they roll over those loans. So that is something that we are still uncertain. Yeah.